All right, according to my clock,
Yeah,
it's 6 o'clock, so we're good to go whenever you are.
Okay. Can I have a roll call?
Trustee Bree.
Here.
Trustee Hallwax.
Here.
Trustee Rubin.
Here.
We have a quorum.
Okay, thanks. Is there any public comments?
I feel bad.
So-
It's not you.
Yeah. Consideration of the minutes. Can I have a motion to approve, or was there anything that needed to change?
So moved. Second.
Okay, all in favor?
Aye.
All right, thanks. And Nikki, do you want to walk us through the reports?
Okay, thank you. So we'll start off with, we have a big agenda. So the good news is the financial reports are good news, so we'll go through those fairly quickly. After we go through the treasurer's report, we'll go through the CIP really quickly with those few updates. And then we have Jamie Wilkie from Watermark and Haven should be reviewing the audit report. And then Heidi Andover from Foster will be going through the actuarial report stuff. So big agenda. And then we'll finish it out with class and comp. Strong. Okay. Few notes on the general fund. As I mentioned, general fund continues to perform strong. We're 5 months into the year already, 41.7% through the year. So that kind of gives you some context of the percentage of budget that we're through the year. No new news on property taxes yet. We're still very hopeful that that second installment will come in before December 31st. So we're just crossing our fingers there. The good news is we're on track with where we should be for this point in the year. So as of right now, property taxes are in a good place. Sales taxes is really coming in strong. We're on track to end the year about $300,000 over budget. So that continues to perform really strong. As we talked about before, we are starting to see that shift between sales tax and use tax. When we look at our projections for use tax, we're only projecting for that to come under budget about $3,000 for the year. So we really are seeing that kick up in sales tax. Permit revenue, we've seen a rise in the volume of additions and renovations. So if you look at the financial projections the last couple of months, we've really seen that revenue kick up as well. And then places for eating tax, which is slightly shy of that 41% target through the year. But when we compare the same 4 months of taxes for this year compared to last year, because we had that 1 month delay last year, we're still running about $7,300 above last year. So that is also performing well. On the water side, our total revenue is lower than last year. We talked about this a little bit at the last meeting, that we had that kind of anomaly with the Village of Northfield. But we really have yet to see summer usage. So our volumetric revenue is a little bit down compared to this time last year, but we are expecting that to come bounce back, especially with the hot weather right now. So we are expecting to see that irrigation revenue come in. So we'll really start to see that late summer, early fall as those bills are issued. The sales taxes, we talked a little bit about this already. Again, those continue to just go gangbusters. The May receipt was for February sales, and even though that was kind of down compared to some of the other months, it's still much stronger than last year. Overall, we're projecting the general fund to come in about $959,000 over what we were budgeting. Obviously, the big driver of that is sales taxes. Personal property replacement taxes have consistently outperformed IML estimates. So it's really good news from a revenue standpoint. The projected water fund revenue impact is coming in at about $9,000 over budget. So again, I would expect to see that pick up here in the next few months as we start to see that water irrigation kick in. On the other side of things, we talked a little bit about this over the last 2 finance committee meetings. One of the things that we talked about was if we get to a point with the property taxes where we don't receive the second installment, are there any capital projects that we could kind of shift over and use bond proceeds from the referendum that was approved in 2021? So we did identify about $445,000 worth of projects that would fit that description. That was in the bond official statement, so we should feasibly shift those and lighten the load on the general fund and use that for capital projects instead. So really, we're looking at sanitary sewer projects and that one safe routes to school program. Now, in addition to that, and we'll talk about this in a moment with the CIP, we have already started to see some supply chain disruptions, which is probably surprising to no one in this room. We've identified 2 public works vehicles that we will not be able to source this year at all. And then there are going to be some significant delays in the delivery of our public safety squads. We were told at least it could be as much as 300 days.
Yes.
Okay, but we're hoping for less. So we're hoping that we'll still get delivery this year. And then lastly, kind of the golf course equipment, really having trouble finding new equipment, right? And used equipment is also kind of difficult to find. So those are really the impacts. We don't have anything at the golf course that we know we can't get quite yet. Still kind of holding out hope there. But these are really the things that we're watching in terms of a local impact. Any questions on the treasurer's report?
Just on the expense side, not CIP type stuff. Are we seeing anything?
We're starting to see some upticks in a lot of our supply costs. I know we just did a major supply order for our sewer division, and it was almost double what we would normally pay. So what we're finding is that we have to scale back some of our purchases of what we would normally stock and do more kind of adjusting time with some of our products. There hasn't been anything that's really halted operations yet. I mean, we haven't gotten to that point, but we are trying to adjust our habits a little bit. And obviously we're seeing people that have through the road.
Maybe we could start talking about that a little bit more, not fuel, just expenses, because tax receipts are great because prices are up. But that's what it is. So.
Questions? Okay. So we're moving on to the golf club update. We'll turn it over to Stella.
Thank you. May was a terrible weather month for us. We were way below in our rounds count. We had 3 days where we had 0 play, which is very unusual for May. We were able to make our budget with some expense savings and a couple of tiny issues with some revenues. So that was okay. Our golf academy, we started our day camps. We had our mini camp in May with 5-year-olds. So that started. We have our new instructor on board. He's getting some new business, but it's going to take a while for him to get some clientele. So golf academy revenue is still behind. Friends of the Glencoe Golf Club, we're working on some different initiatives, trying to come up with some benefits for different levels of giving. And Pam is currently working on a $10,000 level, which a lot of people have shown some interest. We have also received a verbal commitment of $125,000, and we're hoping to actually get that check within probably the next 4 weeks. And that's the report for me.
And just as a reminder, we've got an agenda item on the committee of the whole this week that is going to be focused on the work of the Friends as well as the clubhouse project itself. And so Pam is going to be joining us on Thursday night to talk a little bit about what as Stella was just referencing as part of that presentation. So
Maybe it's in there. And I just missed it, but maybe we could keep a running tally of what's in the fund.
I don't think it's in there. I don't think we have a line item on the Friends, so we can add that in.
CIP updates. Pages 55 through 57. Many of these items we've kind of touched on, but we have the updates on the schedule highlighted in blue. We've pushed out the timelines, obviously, for the delivery of patrol vehicles. the public safety kitchen renovation, downtown streetscape, and traffic controller modifications. So those timelines have all been updated throughout 2022. And then the Public Works Transit Van that's out of the water fund, that was changed to a TBD. We're really not sure whether or not we're going to be able to source that. That's one of the vehicles that we have identified as a potential for a hybrid vehicle. So we're still kind of working through whether or not we'll be able to obtain that this year. Also, for the board consideration on Thursday night is a purchase of a asphalt hot box trailer. Things over there. Okay, so it
He
is
knows
a
what it
tow behind, right? A tow behind vehicle. He's nodding. It is a $40,000 purchase. We are proposing to purchase these items with the leftover budget funds from the 2 vehicles that we know we cannot obtain. The hot box trailer was included in the CIP. It was in the schedule of replacements, but because we can get that, we're going to bump that up, and then we'll move the vehicles that we can't get out. So that'll be on the agenda for Thursday, and then after the purchase of that, we'll still have another $230,000 remaining from those vehicles that we won't be purchasing. Okay, we're just rolling right on. Okay, so just one quick note. I think we might have touched on this last year. The comprehensive annual financial report has been renamed to annual comprehensive financial report. There apparently the acronym CAFR, it has a negative connotation in certain cultures throughout the world, so they have swapped the order of the words. So the acronym is now CAFR, I guess. Just rolls right off of the top.
So much fun. It's in
It's
South Africa.
South
Yes,
Africa
it's a South
slang.
African slur.
Yeah.
So
Very good.
So that will be
It
a difficult habit to break. Yes, I'm using the word CAFR. So I might just be using the word annual report because it's a little bit easier, or audit in general. So just a few notes on the background of our audit timeline. So we started this back in February with internal controls testing. And you'll hear from Jamie about this in a moment, but as you all know, audits are not designed to test fraud, but really more so to verify the reliability of our financial statements. So as part of the internal controls testing, the audit team does come in and they pick a selection of transactions to test to make sure that we have internal controls in place and that they're effective. Some of the internal controls that we have in finance, to give you an idea, we have dual approval on all bank transactions before transferring or wiring money, dual handling, cash register accounts. Our public safety department is kind enough to deliver our deposit every day in a locked bag, so that function is separated. And then we also have dual approval and review on all financial transactions. So that big fancy ERP system that we got allows us to record all the audit trails on that and all of the approvals on our bank recs, our journal entries, issuing invoices, utility bills, anything financial has that dual control on it. And then it's obviously recorded in the system. So that happened in February. Then our final field work was a combination of hybrid and in-person and remote work. And that happened during the weeks of March 18th and then March 28th. And that was really kind of the meat of the audit where we're going through all of the financial transactions for the year. And then to round out this timeline, we have a number of required filings that we'll have to complete by the end of this month and early July. And that includes not only the ACFR and all the places that needs to be filed, but we also have some reporting with the state of Illinois. We have a required filing that goes along with our bond obligations. We do have to file online for that. So we have some required disclosures there. And then we'll also be completing the popular annual financial report, which is really kind of like the budget in brief. It's a condensed version of the ACFR that's supposed to be a little bit more readable, user-friendly for people. So that's still under construction. We're hoping to get that out in June 30th. So at this point, I will turn it over to Jamie to talk a little bit more about the report.
Well, thank you for having us this evening. As Nikki indicated, we'll kind of walk through the audit itself. I'm Jamie Wilkie, one of our audit partners. I know I've seen many of your faces in years past, so nice to see you guys in person this year. That's really lovely to be able to do these presentations in person. Certainly want to start off by thanking Nikki and her team. Obviously, as she indicated, there's a lot of work that goes into the annual audit, really a 6-month process from start to finish. So certainly we are not able to present a clean audit without all of the efforts of the team internally. So thank you very, very much. It is again a clean audit year. So certainly always thrilled to work with the team here. They're always cooperative, providing all the information that we require. So thank you again. I will start off by reviewing the large bound document you have in front of you this evening with the lovely patriotic picture here on the front. So I'll just point out a few key sections within the document, maybe a few key financial highlights, and then certainly I can open it up for any questions that the committee might have. So we'll start on page 7 of the document, which provides a copy of the Certificate of Achievement for Excellence in Financial Reporting. This is the organization that basically votes on your ACFR. I have to catch myself as well. Really about an 1.5 inch thick checklist each year that the village has to conform to in order to receive the Certificate of Achievement for Excellence in Financial Reporting. So you'll see we have provided a copy of last year's award on page 7. We will again be working with the team here to submit this year's audit to the program. That's one of the annual filings that is required by the end of this month. Certainly anticipating receipt of the award again for this year. If we flip just a few pages, then you'll see the independent auditor's report beginning on page 10 of the document. As Nikki indicated, while we are not opining on actual internal controls, we are required as part of the annual audit to do an overall assessment of the control environment, take a look at policies, procedures, walk transactions through the system, observe, what types of controls are in place, and also we do go through third-party confirmation on many of the material balances on the books. So again, we are not indicating any findings this evening. Those would be deemed significant deficiencies or material weaknesses. So no internal control related findings as part of our testing. You'll see on page 10, the opinion paragraph is provided as the very first item. I will tell you this is a change this year. Our auditing standards have flip-flopped kind of the order of the audit opinion for this current fiscal year, which I am happy because it's nice to have the opinion as the first item when you read the independent auditor's report. So what we have indicated this year for December 31st, 2021 is what we call an unmodified or clean audit opinion. That means the financial statements as presented are in fact materially correct. If we flip just a few more pages, you'll see starting on page 14 then, probably one of the most important sections of the document, labeled Management's Discussion and Analysis. As Nikki indicated, this is a rather large, cumbersome document to try to digest in a sitting. So the MD&A, as we call it, is really intended to be the executive summary to the report. I always encourage our board members to read this section in detail. It is in fact prepared by management, so kind of their narrative of the major results for the fiscal year. But I do want to point out just a couple of items here on page 14, and then we'll kind of see those as we briefly look at the financial statements. Bullet point number 1, you'll see overall performance for the village did increase this year to the tune of about $7.2 million, excluding our pension related activity. And I know Heidi's going to highlight some of the pension stuff here after my presentation. So overall, we obviously saw the impact of some of those positive revenue results in last fiscal year as well. That trend really started in the prior fiscal year. As we take a look at bullet point number 3, then just want to point out the business type activities which make up the village's water and golf funds also saw positive results for the year. Overall equity increased by about $2.7 million in those two funds combined. General fund summary presented as bullet point number 4. Obviously, the rebounding of revenues and the strong sales tax, income tax, PPRT taxes that also occurred in 2021 resulted in about a $630,000 increase to the general fund for the fiscal year. So just wanted to point out just a few of those key bullet points. As you continue through the MD&A, you'll see summary financial results, discussion on capital asset activity, long-term debt activity, and then individual fund analysis of some of the major trends and results for the year. So I'm trying to keep it high level this evening, but again, if there's specific questions, once I'm done, we can certainly address those. If we flip then to page 30 of the document, it begins our actual financial statements. Page 30 and 31 provides the balance sheet for the village, all funds, and all reported under the full accrual methodology, meaning we are recording long-term capital assets as well as long-term debt in this one balance sheet snapshot. So the important number to really look at year over year is at the bottom of page 31, that being our total net position or total equity for the village. You'll see our governmental activities, so that would be all funds excluding water and golf are included in that column. And you'll see total net position ended the year at the bottom of page 31, just north of $56.6 million. Business type activities again include water and golf. They ended the year just north of $10.9 million in total equity. And then we are required to disclose, just wanted to point out the library as a discrete percentage component unit, so you'll also see their summary activity included. We take a look at page 32 and 33. I know this looks kind of like a funky income statement, but it is an income statement. Again, for all funds of the village under the full accrual methodology. So again, accounting for the activity related to long-term capital and long-term debt. You look at page 33, the third line up from the bottom on page 33 actually provides our change in net position or overall income or loss year over year. You'll see the governmental activities column increased net position $4,483,000 for the year. Again, that's really the result of some of those strong revenue performances. Business type activities increased again $2.7 million. So total equity for the village, excluding that library activity, increased just north of $7.1 million towards the bottom of page 33. Any questions on any of those kind of just high level financial results for the year? I do want to point out then the notes to the financial statements. We won't go through these in detail, but certainly want to give a page number reference. So if you're looking for any of the supporting charts, additional narrative discussion, those begin on page 48 of the document. You'll see information related to capital assets, long-term debt, pension-related activity, and investment and cash holdings as well would be kind of the major categories within the notes. The last section I want to point out then is all the way at the back of the report, starting on page 143. I point out this section because there really is a wealth of information starting on page 143 and taking it all the way through the last page of the document. This section is what we call our statistical section. 10-year trend information is provided within this section. The first several schedules will cover financial results for the last 10 fiscal years. As you continue through that section, you'll see 10-year trend information on property taxes, long-term debt, economic indicators, demographics, number of full-time employees, for example. So I do always like to point out this section. There's quite a bit of historical context here within the audit document that is provided and rolled forward each year on an annual basis. Certainly happy to open it up for any questions on the audit document itself, or Nikki, if there were any other highlights on your end.
I have one question, just
Sure.
to this page.
143.
Yeah, the change between 2015 and 2016.
So
What
you're exactly the same thing.
what is that?
Yeah, so that was
80.7.
Yeah, so that would have been the year in which we had to change how we recognized our pension obligations. So that'll be some of what Heidi will be highlighting. GASB 68 in particular would have been a statement that significantly affected the overall net position. We used to have to disclose our pension obligations, but never report them in the same manner on the balance sheet itself.
As part of that seeming unrestricted.
Yes, that's what's hitting your unrestricted category.
Effectively, that's just the obligation increasing.
Yes, the unfunded component of the pension obligation. Yep.
So do you, when you do these, do you end up with a sense of the overall financial health of
Sure.
a town?
Sure.
And so how do we fit in? And second question would be,
Sure.
you know, as we move into an era of potentially different levels of inflation,
Sure.
where do you see problems coming up historically? So where it's actually-
So I think, you know, page 143 and 144 are probably the best schedule to look at overall financial health for the village, because once a year we take all of those funds, combine them, report them under full accrual, and to me, that's the measuring stick, community by community, right? So everybody has to pick up their long-term related activity, and so we get that snapshot. So for you guys, when we talk about financial health, we like to see kind of the growing trend, which you can certainly see on the bottom line. Total net position for the village has, you know, really kind of improved since that implementation of the GASB standard, if that makes sense. So, you know, if we see that kind of trend going downward, that would be an area of concern, meaning the value of the village is depleting year over year. So with this, you're seeing the actual value or equity of the village is actually increasing each fiscal year, meaning we're continuing investments in capital assets, we're retiring debt overall. We're seeing, you know, in many years, some improvements to those pension obligations. And so those are the types of trends that you would want to see year over year. One of the largest kind of measuring sticks of financial health in the municipal space, and I'm going to send you to a different page number reference, would be reflected on page 38 of the document. And much of the focus oftentimes is on the general operating fund. Obviously, that's kind of the primary operating fund for the village. And oftentimes the ratio that's kind of analyzed community to community is what do you have in your fund balance as a ratio to what your operating expenses are on an annual basis, meaning how many months could you cover operations provided no revenue streams coming in the door. And so if we look at the bottom of page 38, the general fund ended 2021 with fund balance of just north of 13 million. Your operating expenses are right about the middle of the page, and those sit just north of 19 million, meaning you almost, you know, 70%, you're covering more than, you know, 6 to 9 months of operations basically within what you have in fund balance. I can tell you there are communities that barely hit the 3-month mark. So that's kind of a ratio we look at. I think, you know, in this area, we do see ratios kind of exceeding 6 months to 9 months, even 12 months within that kind of reserve concept. But certainly if you move to other areas within the Chicagoland area, you would see that number really more in the 3-month to maybe 4-month area. So that's kind of a measuring.
Do you give a qualitative, this is sort of the right level to have?
No, there's best practices that are out there. The Government Finance Officers Association, you know, does put some general guidance, but I will also tell you some of that is very specific to the community. And some of it depends on your year end versus when your property tax calendar comes in, because that's what you're really kind of reliant upon. So part of the discussion right now with all of our Cook County clients is bridging this gap when the county has in theory fallen apart and can't get the job done, and trying to, you know, determine, you know, what should we have in reserve as of fiscal year end, and then figuring out when's that next cycle going to come in and when's the bulk of our expenses that are going out the door and how to match that cash flow appropriately.
Okay. And then do you point to any areas that you have seen where municipalities didn't pay close enough attention or saw something, not fraud, just sort of, you know, we're in shifting times. And just curious if you've seen sort of municipalities run into an issue that they didn't recognize early enough.
Yeah, I would say it's not common in the surrounding communities here, but There are definitely communities that I think have ignored their pension obligations, and there's a lot of volatility in those obligations because of what happens in the market, and we're experiencing that right now. Last year, everything was positive about investment returns for pensions, and I could go to every board meeting and say, this is great. I can tell you your IMRF obligation is 113% funded, and your contribution has probably gone down the last couple of years, but guess what? Next year is probably going to look completely different. So there's things that are out of control, but the idea to recognize that there can be volatility and then making sure that fund balance policy in particular kind of is able to respond to that type of volatility.
So pensions is the big one.
Pension still is, I mean, as much as I hate to have that be the focus, you can see from the numbers it has significant impact.
Yeah.
So the other piece I will tell you is there was a long stretch of time where I think there were communities who delayed capital projects, and now we're seeing infrastructure that is heading towards really needing replacement, and there are several communities that really don't have a funding plan to meet those needs. Meaning you're going out and having to issue debt to put on the books to be able to meet those capital replacement needs. So those are probably the big two right now.
So are there any other pieces that we ought to?
I think in this document, unless Nikki's got anything else. The other document that was provided was the management letter. I don't need to spend too much time there. We did provide updates to prior recommendations. Yeah.
Oh, no.
We'll get that fixed. We'll get it.
Who's got a Sharpie?
Yeah, right. We need
Just
a
cross it off.
navy blue Sharpie. Yeah. So within the management letter, we have just one new recommendation for this year. It's really not a finding or a true comment, but really an FYI of a coming GASB pronouncement related to leases that will be effective for next fiscal year. So we do have to take a look at any leases that are on the books, both from the expense side and the revenue side of a lease transaction for the village. And there are some fairly significant changes that GASB has proposed as part of that new statement, but we'll be working with staff to implement that next year.
Do we have any pieces on the?
We have to look at
We've got a
more
few.
than you think,
Mhm.
yeah.
Yeah, I would have no idea.
Mhm.
Cell tower leases, probably the most specific or significant ones. Then there may be a few small here and there, but I think cell towers are probably the ones that we focus on most.
So will the change hurt our position or help
There's-
our position?
Really neither in the long term. It's just, we never had to record on the balance sheet kind of the asset that you're gaining from leasing something and then the offsetting liability. So the net effect in the first year is really zero, if that makes sense. But then we'll start to write down both the asset and the liability as the lease term continues.
I don't think we're, unless, other than some equipment maybe, I don't think we're the lessee under those leases that you're talking about. We're the lessor.
Correct,
And consequently.
correct.
Right.
We'll be fine.
It's a revenue stream for
Mhm.
us.
Right. And
Yes,
that's not
yes.
changing,
Right,
right?
as opposed to an
Not,
expenditure.
you know,
The golf cart leases.
The golf cart, right, and they may
Yeah.
not
So if
qualify.
we had,
yeah.
if we were leasing something that.
Yeah, if you're
a
leasing,
bad asset, then it would hurt us.
Yeah,
If
if
you're
you're-
revenue attached to it.
the leasing your office, the way it's going to appear, it's like, we'll just have to provide financial stuff.
Right.
It's got much more complicated.
And then the other three comments were really prior disclosures within the management letter. All three have been fully implemented, so they will be removed from the management letter next year.
One other just question sort of generally. So accuracy of budget, does that play anything into your audits?
Not technically, no, no, other than from a compliance standpoint, we are required to make sure, statute, passing of ordinance and all of kind of the compliance related components to the budget, but not necessarily the management approach to the budget or how things are budgeted for.
I don't have any. Unless anyone else does.
much.
Thank you.
Thank you.
Thank you so much.
Just as a reminder, Thursday night, Jamie, you're not gonna be there Thursday, right? Tim is gonna be there.
Yeah.
So there will be another presentation of the audit at the village board meeting under the village manager's report. It's really just an acceptance. It's a formal component of the auditing process. So there'll be another shot at asking questions if you are so inclined. Thanks, Jamie.
Thank you. Actuarial report. So. Okay, so included in your packet is the actuarial report. We'll switch to this, to the actual report in a moment, but just kind of a quick snapshot of our results. So as of December 31st, the police pension fund finished with $42.1 million in assets. I don't want to steal Heidi's thunder, but we got a 7.77% investment return, which is good news because that exceeds the assumption that we have 6.5. And our required contribution is going up slightly to 2.6 million. The prior year recommendation was 2.45 million, but as you might recall, when we started talking to this part of budget and after our extensive discussions on changes to the policy, the funding policy, we decided to keep that contribution the same as the prior year rather than dipping down. So we actually contributed that 2.5 million. On the fire side, we still have that one remaining beneficiary. This is funded on a pay-as-you-go basis, so that those assets have not been consolidated as part of the statewide consolidation. And the required contribution is that $48,000 number, which is essentially the value of that benefit. That will remain the same under statute for that surviving spouse for the remainder of her annuity.
That 42.1, 7.7 is the one.
December 31st. So that picture looks.
Fiscal year end.
Yes, picture looks a little different today. So at this point, I will turn it over to Heidi and the first one, Foster and Foster, and if you could switch over to the actuarial report.
Thank you for having me here tonight to go over this. I know pension's been coming up a lot so far tonight. So it's nice to have an opportunity to speak towards some of this. Now, I'm going to focus on the police pension fund. Obviously, as Nikki mentioned, the fire fund, it's effectively pay to go. The beneficiary in that fund is about 91 years old at this point. So you might pay 10 more years. My grandmother is 98, turning 99 in a couple months. We don't know. But, you know, so that one's not really anything we can address. But in terms of the police pension fund, obviously, this one's an ongoing fund. And I'm going to actually flip you to page 5 of our report. One more up. There we go. This is sort of the bottom line on top here. I know that's very small for those of you that don't have it in front of you. But basically the left-hand side is going to show you this year's numbers. The right-hand side is going to be comparison with last year's numbers. Oh, thank you. That's very helpful.
There's this in the packet.
Page
Page
8.
5.
Page 8. Yep. I have Patrick. Okay, so the left-hand side is going to be this year's numbers that we calculated. The right-hand side is going to be last year's comparison year over year. As you can see, the village recommended amount increased about 8% year over year. And I'll get into more detail about what caused that increase year over year. But the biggest issue was we did have some administrative expenses that popped up this year. Sort of anomaly, we do fund those on a pay-as-you-go basis. So that piece is actually funded and can be volatile. It's usually too small to make funding on any other level not worth doing. This year was just a strange year for that. So that's really what caused it.
Litigation.
Pardon?
It was litigation.
Oh.
Pension fund litigation.
Mhm.
Yeah.
There was a dispute of one of the benefits.
So hopefully you don't have too many more of those. They're pretty rare. So that did cause the pop up of largely this year. So if we look at page 6, which is page 81 in the packet. We do
One
list
question
here.
about this. What kind of insurance do we have for something like
So under Irma, we do have some fiduciary liability insurance coverage for the pension board.
Yeah.
In this scenario, what ended up happening was, there was an individual that retired on a non-duty disability pension. He opted to convert it to a retirement pension. And there's some confusion with how the statute reads. And this individual officer interpreted it or received bad information that he thought he would convert to a regular retirement pension. When you retire at a non-duty disability, you get, it's 50% of your salary when you retire. This individual officer was in a very unique situation in which he had more years of service credit, but not the age to retire. So had he waited, he could have retired at 62.5% of his salary, which when you have 3% compounding increases, that matters in the long run. But that's not the way the statute read, and that's not what case law has interpreted. So when he converted his pension, we had to keep it at 50%. That accelerated his annual increases, but that doesn't make up the difference. So we went through the litigative process. It went through the administrative hearing process in the courts. The village won, and then he appealed the case, and then we ended up settling for the difference, essentially the net present value of the difference between the two pensions. So that was a very
And that was all
unusual.
not insurance, we paid for all of it.
We ended up paying for it because it didn't qualify under like the fiduciary. It wasn't an error on our part.
Wait, so we settled for the full amount? Basically, we just,
It was the
we
net
just said,
present
oh, you're
value.
gonna win?
No, it was the net present value between the difference and I'm trying to think.
We didn't split?
I have to look back.
Right. Because, yeah, the way you said it, it sounded like we basically just said, once the appeal, we said, okay, we just won, but now we're gonna write you a full check anyway.
It was under appeal and it was still going. We had no guarantee that we were going to win. at
But if
that
we
point.
lost, we wouldn't have lost any more.
This did
This,
come
so
before.
So
the
this is,
board.
we talked about this in closed session.
Okay.
We won't go into that.
All right.
Keep in mind, the pension board
Mhm.
operates independently from the village.
Yeah.
It makes its own decisions. The village has the authority to appoint 2 members of the pension board. The pensioners have the authority to appoint 3. And so the members are skewed in, if you will, against the village's interest. However, the litigation proceeded down the path that it proceeded, we believe, appropriately. We can get into, and I think it's more appropriate in a closed session discussion, kind of the details of the litigation process, as you can understand. There's a lot of nuance, and Nikki's trying her best not to disclose in a public meeting, perhaps some of those closed session discussions. So I,
Okay, well, then
If-
then
if
maybe
we
we should,
can-
we should, on a day when we otherwise don't have a long agenda, maybe
Sure.
talk about that, because it sounds like we should never, we just sort of said, well, fine at the start, and we've been a lot better off.
I don't know that that's true
Okay,
for a lot of reasons. And again, this is a hard conversation to have
Okay.
in this context. So,
fair enough. All right, sorry.
no problem.
Thanks.
No worries.
Okay, so we're on page 6 or 81 of the packet. Changes since the prior evaluation. So as you recall, a planning policy was adopted last year. There was discussions that we had about this with this board, and actually showed you the pension modeler and talked through lots of different
We
things.
can go through it again.
I don't have a modeler, don't worry. But, you know, in the end, it was decided that we were going to reduce the payroll growth assumption. So that started now. That's going to be reduced at a rate of 25 basis points per year until we get down to the 2.5% that's in your funding policy. In addition, coupled with that was a change in the amortization schedule. Instead of funding to an end date of 2040, we are now going to fund on a 15-year rolling basis, but we're going to grade down to that. So this has no impact on the valuation as of yet, because at this point you're still at 19 years. Next year you'll be at 18. You're still following the schedule you were. Once you get to 15, we will stick at 15, and then we'll continue to reamortize on that basis. So those changes are happening in tandem, but the only one that really impacted the numbers this year was that 25 basis point reduction in payroll growth assumption. I do want to point out here that You're probably all aware of police pension consolidation. There was an experience study performed in 2022 on the police pension fund for all of the Article 3 funds across the whole state. At this point in time, most of your demographic assumptions have been relying on the prior study from 2017. That study includes termination rates, mortality rates, retirement rates, all of those kind of things that we have to include in evaluation. They're done on this consolidated basis because no single fund is generally large enough to perform a study on their own, which will be enough retirement experience, enough information, enough disabilities to be able to build a table to predict how. So what we do in Illinois is we take all our three funds, all the experience across all the funds, and we build the tables from those. Foster and Foster has actually performed this study across the state, and there are now, as of 2022, new tables that could be implemented. We have not implemented them in this valuation, but we would recommend we think about it for next year because now this information is available. We have so we were using 2017 tables. We will recommend moving to these 2022 tables in this valuation. It's relatively neutral in terms of impact. You might see a slight increase. I'd say most funds I'm seeing slight increase when these are implemented. Generally speaking, there was just some slight adjustments made to most of the rates in these tables. A couple of big things that should be noted is that retirement rates generally came down. We found police officers were retiring slightly earlier than we'd expected. Given the policing environment right now, this is not surprising probably to anybody. We're seeing folks retiring a little bit earlier than they were before. The other thing that we have implemented is generational mortality. So I don't know if you've not heard of this concept. Effectively, what it is you're saying every year of birth, those folks are going to live a little bit longer than the folks born in the year before them, and a little bit longer than the folks born in the year before them. And so that's the whole generational mortality. We did implement that as well. That generally increases the liability. However, we also found that across all the experience in Illinois, that experience suggested that the base rates were a little bit too high. So we implemented some adjustments to those. So those are sort of offsetting with the generational and such that the mortality should be a relatively neutral change next year. But these are things that we do want to consider for next year. There's also some changes to the salary scale. We noticed the salary is slightly lower than we had been predicting in the past. And then thirdly, and this is not one that I'm recommending to change at this point in time, but the 6.5% post-consolidation may be conservative. It's a little bit too early to tell right now. They're moving the investments. Right now, they don't even have most of them, right? So they're still collecting that money from the pension fund. Once they have that, there will be a passive investment strategy that will be implemented initially, and then they will move to an active investment strategy over a 3 to 5 year time frame. It takes a while to move to all the active investors and such. So during that time frame, we would expect that once the portfolio is in active management again, there are broader, there's less restrictive rules on how the fund can invest now. So right now, the police pension board's been restricted on how they can invest the funds.
How is it invested? What's the allocation between?
Let's see, I actually probably have that information for you. I think it's in here. Let's see if it's on page.
There's a maximum of 60% you can have in equity.
Yeah, it is, but there's other restrictions on the various fixed income and what.
Fixed income long bonds are worse than stocks.
And I don't know the very current investment. I can tell you what the target policy is. And I'll look at that. That will be in the GASB section, probably around page 45 of our report. And you know what? We might not have been able to collect that from your investment advisors this year. Investment advisors this year have been a little bit harder to get information out of because of consolidation. I'm sure you found that. Because obviously they're not. So I actually don't think I have that now that I think about it. They couldn't provide it. But it was generally pretty traditionally invested. The problem is the specific investments, even within equities, even within bonds, are restricted fashion. They're no longer restricted.
In the whole like actual bonds. And just too high amount.
I know. So I'm just curious
50 something.
what we're in for this year when it was only 7.7.
Right, and then, the question is, yes, the value fluctuates on the bond, but the question is if they timed it, if they guess right about how long they want to hold that bond, because it might go up and down and sideways. But you're still just collecting out, you're not selling it.
But
You're
it, I mean, the
still getting
returns
the
are still,
basis out of it.
well, yeah, but that's the, yes.
That's the question is unless they had to sell it early. We're in too long a position given what the liability. That's all, it's part of the whole thing. When they have to consolidate, does that all get turned to cash and then you have to recognize all that hit?
Most of it's in kind. So most of it moved over in kind, only some strange investments right now. And everything. So,
As of March 31st, it was 38.6% in fixed income, 53.9% in equity, and 7.4% in cash equivalents. And that was a little bit higher on the cash end of things because we were prepping to consolidate everything May 1. So it was a little bit more in cash than we would normally hold.
Good. Good that.
Find the actual cost.
and in the end, once you move the money, the policy moves to the consolidated right funds policy, which ultimately does have a higher percentage in equities. It'll take some time to move to that.
I forget, what was the anticipated cost savings of administrating the funds?
I don't remember the exact numbers off the top. I
Remember how
did-
many basis points they thought that?
You
I
know,
can tell you that Fire has already reported that they are realizing $27 million annually from their consolidation on the fire side.
Mhm.
They're much farther along. with-
But that's divided by how many people? How many villages, how many?
There's about 300 plus fire pensions.
Yeah.
well, yeah, fire might be a little lower. I think
Yeah,
it's just
it's
south of 300. It's just south, they're both right around 300. So at least it's a little more than 300 fires.
It's like 640 now or something. total ones, yeah.
Just curious.
So anyway, next year, I think there's several assumption changes that we'll want to look at. Those are not included here. I don't expect those to be anything that will influence numbers in a significant way unless we start looking at investment return. I wouldn't necessarily recommend that yet. I think we have some time to wait and see what happens with consolidation.
And remind me, the returns are like a 3-year average, is that how they're calculated? Am I remembering?
Smoothing.
So you're
Yeah.
thinking of assets, smoothing, I think, yeah, that, the assets themselves are smoothed over a 5-year. So that when we use the actual value of assets, to actually calculate your contribution, we're not using whatever. the market
Based on
says,
the 7.
because that would introduce a lot of volatility.
Right.
There's enough volatility.
So the return is accurate, the number that we use. The return's not smooth, it's the value of the fund is.
So the return is smooth, we show the return both ways, the smooth and unsmooth basis. The number that was actually up there was the smooth return. In this year, the market return was actually pretty similar. It was like 7.71 versus 7.77%. But I'll show you those numbers as you look at the report here, and you can see that it can be correct. The smoothing does happen. So let's turn to page 7 and get into some of the numbers here. Okay, so again, that left-hand column is going to be our focus here. The right-hand column will show you last year's results. There is a middle column here, and this is only to show you the prior to your funding policy changes, the old assumption and method change. The only thing that's going to be different between these two columns is that payroll growth assumption. So right now, all of the numbers are going to be identical. On the next couple of pages, it'll be on page 10 where you actually start to see a difference here. So if we focus here on section A. Section A is the participant data that we received to perform evaluation. And again, this is pretty small, but you can see that there's been quite a bit of volatility in your fund year over year in terms of headcounts. I'm actually going to flip you quickly to page 30 so you can see that better. Page 30 of our report 105 of your packet. There we go. Yeah, if you want to blow that up a little, maybe that would help folks. I'm sorry. It's not really screen worthy. Okay, so at the top here, we do show the exits and entrants from the active population. Now remember, we do snapshot valuations. So whoever's in the valuation on January 1st is who we're valuing. So as of January 1st, 2021, you had 35 actives. That's down to 30 actives at this point. And so that you arrived there a few different ways. You had 4 folks that actually terminated. You had 3 folks that transferred to another pension fund, another municipality, and you transferred money along with that for those transfers. You had 1 retirement, and all of that activity is replaced by 3 new hires. So you're actually down 5 headcounts from where you were as of January 1st, 2021. So you'll see some savings in normal costs as a result of that. I suspect that's an anomaly as of January 1st, and the numbers probably look quite different now. We'll see where we are next January 1st.
So we should probably move back to 35.
Yeah, and to the extent you are, generally those people are coming in with liability, they're only coming in with additional normal costs in terms of the contribution, which when they're younger and newer will be lower. So it's not going to produce too much volatility. The headcounts to be more volatile. If you look at the bottom of that page, we show the inactive ins and outs. The bottom there. There we go. And you can see there wasn't too much activity here. Our 1 retirement showed up to increase our retirement counts, and we did have our 4 terminated investments show up to increase our terminated vested counts. No deaths, so that obviously is going to be a loss to the fund this year. Obviously, when you do have deaths, we generally gain. So because those happen in discrete increments, you'll see gain and loss every year, depending. So we move back to page 7. On page 7 or 82 of the packet, section B is going to show you the assets. So here you can see that the actual value of assets lags the market value of assets. So what that tells you is that you have deferred gains that you're not yet reflecting in your assets. So that tells you in the past 5 years, generally speaking, the market's outperformed the actual assumption on investments. And so those gains are going to help you in the next year or 2 to the extent that we actually see some losses that should help offset that. And that's exactly what the actual smoothing is meant to do, to mitigate some of that volatility. And so the relationship at this point is that actual value is about 3% higher than market value. Okay, so then if we look at section C at the bottom, this is the first liability calculation that we perform. This is the present value benefit calculation. This is basically saying if you had the number at the very bottom of that leftmost column, $75 million in the fund today, and all of our actual assumptions came true exactly as we predicted, you would be fully funded and not have to contribute any more to the pension fund on behalf of this population. Which is say new hires coming in, they wouldn't be paid for by this. But that number isn't something logical to fund to intergenerational equity, all sorts of problems with that. You really want to fund as folks are accruing these benefits. So if we turn to page 8 or 83 of the meeting packet, you can see that near the bottom of that column, we have the actual accrued liability of $67 million. That is representative of liability that has been earned to date. So that's taking all of your inactive liability plus your actives based on service that they've already earned in your pension fund. So that is the number that we fund to. We compare that to the actual value of assets to arrive at the unfunded actual accrued liabilities, which is just below that $67 million number there.
Can you
And-
scroll down one? Thanks. Perfect.
Yep, the $25.2 million number is the basically liability for past accruals that have been earned but not yet paid for by the village. And so that's one of the line items in your contribution. You effectively have a mortgage on that past accrual that needs to be paid down. And that'll be a component of your contribution until that number is zero. That gives you a funded status of 62.6%, which is an improvement of about 2% year over year. So you're moving in the right direction. That's good to see. The only other number I want to point out on this page is that total normal cost number there near the top, at $877,000. That is the value of your active population earning 1 year pension benefits and pension fund. So if you were fully funded, you would still need to pay for that 1 year accruals.
What slide was that?
That's the total normal cost near the top there,
877.
$877,665. Okay, now that's the total normal cost. The officers pay 9.91% of their salary towards that number as well. So the village is not on the hook for all of that. And we'll show you that on page 10, which is 85 in the packet. And that is in section E here at the top, the pension calculation. So again, focusing on that leftmost side, you can see that we have normal costs plus administrative expenses And if we subtract from that the expected member contributions, in a perfect world, that would be your annual contribution. If you didn't have this unfunded liability, this mortgage that you have to pay in these past accruals. Right there in the middle of the page, $1.8 million, your contribution would only be the normal cost minus the piece that the officers pay plus the administrative expenses. Here you can see those administrative expenses did go up quite significantly. As I said, we do believe this is an anomaly. We don't expect that to happen every year, but it is funded on a pay-as-you-go basis, basically. So there's volatility in that piece. We do have that big number in the middle there, though, that $1.8 million. That's about 69% of the contribution that we're recommending, which at the bottom of that column in section E there is that $2,663,500 payroll. So year over year, there was that 8% increase, and you can see how that was largely driven by the administrative expenses there. If we look at section F on this page at the bottom, one of the places I like to look at for the health of the fund is to see how is the village contributing relative to the recommended amounts. And if we look at the recommended amount for the time period that we're looking at here, it was about 2.5 million. The village did exceed that amount by a bit. And so we can see that the village is meeting the obligations as recommended. And that's always good to see. More than funded status, this is something I like to see going on because there's many municipalities that consistently are funding 80% of the recommended amount. And as you can imagine, that eventually does catch up to those municipalities. Okay, so let's turn to page 11, which is 86 in the meeting packet. So at the top here, this looks a little bit different than it did last year in section H. You can see that the projection of the unfunded actual accrued liability based on how we expect you're going to be amortizing that unfunded now doesn't go down to zero. So in the prior evaluation by 2041, you did go down to zero with that number. But if you recall, that required quite steep contribution near the end of that time period. Because you've moved now to this 15-year rolling methodology, you're going to slowly approach full funding, but at that 2041 date, you aren't going to be fully funded. So you'll be still paying down that unfunded liability. The other number I'll point out here at the bottom of this page in section I2, because we were discussing the actual market returns versus actual actuarial returns. You could see here the market returns show up in that first column. The actuarial returns show up in the middle column, and you can see that they're much more muted. So you can tell your actuarial smoothing method is performing as expected in the sense that it's that volatility that you see in the first column doesn't appear as dramatically in the second column. And so that's just the effect of the 5-year smoothing. Okay. We turn to page 12 or 87 in the meeting packet. So pointing out here, you are still funding a little more, scroll down closer to the bottom there to that schedule. Here we go. Yep. You are funding over 19 years still. So remember, we're grading down with the 15-year schedule. So this is 19 years, but you are using the 3.25% payroll growth assumption. So that gives you an amortization amount of 1.7 million. Now these are beginning of the year calculations. When we rolled that into section E on page 10, we did apply interest because we know the timing of when these contributions will be made is not beginning of the year, it's later in the year. But I did want to point out, ultimately, your target is the 2.5% payroll growth assumption. If we moved that immediately and we didn't grade down to that, your contribution would be 1.8 million, so about $100,000 more. If we immediately jumped to the 2.25% payroll growth assumption instead of 2.5. So we'll continue down that trajectory in future evaluations. I just wanted to mention that.
Are we going to revisit the payroll growth assumptions?
With respect to any of the assumption studies, I would not say you need to do that at this point in time. As long as you're working towards grading down to something like a 2.5%, I think we feel good about where you're going to land there. Are you thinking of it from an inflation perspective? Or are you thinking, okay. So as an actuary, I would tell you, I would love to have a 0% payroll growth assumption, which obviously, you know that your department payroll is going to grow year over year. But what a 0% payroll growth assumption is effectively saying, I'm going to amortize my unfunded liability just like a mortgage on the house. Get it paid off, same dollar amount every year, and it'll be done. It's not tied to your annual pay in any way. Beginning your mortgage percent, the mortgage that your pay is much higher, but your amortization on that payment is not different. In a perfect world, that's how you're funding this. Not many municipalities do it. We have a few that do, not many do. But the lower you can afford to move this assumption, the quicker you pay down your unfunded. So the more you increase this assumption and you truly try to track this, what it's trying to do is make your amortization payment a consistent percentage of department payroll. It's sort of a weird concept because I talked to the folks that are actually budgeting this. That's not how they're thinking of paying down the pension obligation. And you're really trying to have a predictable pattern of payments in the future that aren't increasing at a significant rate that you can't afford out in the future, which is what we showed the model last year. You get pretty good. So as assumptions go, this is one of those assumptions that I don't tend to consider real close to reality. And the lower it can be and the lower you can afford it to be, the better off you are longer term. Short term, they'll be a little pain, but I would not recommend trying to track this. Okay. So if we turn to page 14 or 89 of your meeting packet, this will show you the year-over-year changes in the contribution requirement. So we start with last year's number at the top of the 2.5 million almost. Shows you all the line items that influence that, and at the very bottom we get to the 2.6 or 2.7 million almost that we're recommending this year. So it's an increase of about $200,000 from our prior year recommendation, and you can see that that is largely driven by those changes in administrative expenses. So next year we really hope to see that reverse out, and hopefully you won't see that increase. There were some other things that did influence this as well, though. So the changes in the head count, so the decrease in 5, you can see that your normal cost went down in a significant way. They're near the top. Now that's near the top there. There we go. That $86,000 decrease just due to the fact that your head counts were lower. So next year that might also reverse. We also saw active decrements cause a gain to the fund, so about $73,000 decrease in your contribution just because you had a lot of turnover. You had a retirement, you had 7 folks leave. Hopefully that doesn't happen to you for other reasons beyond the pension fund next year. So that might reverse next year as well. So some things to highlight there. In terms of the assumption method changes, near the bottom there, that 3.5% payroll growth assumption did, by dropping that 25 basis points, you did commit to increasing your contribution by about $36,000. So next year you'll see something similar again, but we drop another 25 basis points. So there's sort of some gives and takes with respect to some of these numbers. If we turn now to page 16 or 91 of the meeting packet, this is the projection of benefit payments from the fund. What we are doing here is basically taking that very first liability number that we showed you. If if we had $75 million in the fund today, we'd be fully funded. We take that number, we project the benefit payment stream that supports that number. We project actives in the first column. Once you're in a column, you don't leave a column. So this is basically actives as they retire out. Inactives, unfortunately, there's only one way to leave that column because once you become an inactive, the only way to go out is mortality. We add those together, the final column, and that's the projected benefit payment stream on the population as it exists today. If I look at that very top number there of about $3.6 million, that's about 8% of your market value of assets. I like to look at that to see where that is in terms of liquidity on your fund, and cash flow and such, because obviously, we see some funds that are north of 15% on this. They do have to think about how to invest a little bit differently. That's going to become a little bit strange now in consolidation because you'll have less control over those kind of things. Your fund doesn't seem to be in a dire circumstance there. There will be funds where that can be an issue, and the volatility of that cash can be a problem. So if we turn to page 17, which is 92 of the meeting packet, here we look at the actual assumptions. And I talked about most of these, but just to highlight what we did, what we will touch next year here. We probably are not going to touch that interest rate. Right now it is built into your funding policy, so to touch it, we would need to change the funding policy anyway, but we're not recommending doing anything there. I think we're in a wait and see position there. Being lower is conservative, so the only direction to really move here is probably up, and that will bring liabilities down, but we think being conservative here is probably the better course of action. So I mentioned mortality. We are using those public sector tables right now. We implemented those several years back. Those are the same tables that are being applied on a generational basis in the new study. And so we would implement those retirement age, disability and termination are next year on the list. So we scroll down. All of those we would recommend updating. And if we turn to page 18, the salary schedule at the top here as well. So that schedule came down just a bit from where it is here. And so we would recommend implementing that as well. Near the bottom of this page here, you can see the implementation of the funding policy. We did lay out the amortization years and how that's going to look here for you. And then the payroll growth of 3.25% is implemented. Eventually that will be coming down to 2.5. So I'm going to turn you all the way to page 28 now. Probably the best news you've heard since I started talking. Okay, so page 28 is 103 in the packet. This is the statistical data of the fund. So a couple things to point out here. Again, focusing on that leftmost column is the most recent data that we received. Your tier 1 versus tier 2 splits are they're exactly 50 at this point in time. So what's relevant about that is the tier 2 folks earn benefits at about 10-ish% lower than the tier 1 folks. So the more folks that you have coming in as tier 2 and leaving as tier 1, you should see a decrease in your normal costs over time. And we did see that with the modeler last year, if you recall. If you look at your retirement, your retirees, about age 65-ish, that's relatively typical. Beneficiaries, about 74, also pretty typical. Your disabled are a little bit older than average at 64. And then just to point out, we do list terminated vesteds at the bottom of 6. Really, 3 of those are due future annuities. 3 of them are just due a refund of their own monies. They're vested in their own money, so we call them vested because they are vested in some cash and pension fund, but it's only if they come back to the fund and say we want our money. There's no interest on that money required to be paid to them, so you're just earning money until they come and ask for it or ask for it to be transferred. Okay, so if we turn to page 29 for the meeting packet, this is an age service distribution of your active population. So we have age in 5-year increments across the left-hand side. Across the top, we have service buckets. We focus on the bottom left-hand corner of that page. We look at anybody over 20 years of service, over age 50. We find that there are 6 folks in that category. So currently, as of evaluation, there are 6 people that could retire from the pension fund. Obviously, some of those may have already retired in the first 6 months of the year here. That's possible. But just to point that out, there's only one more if we back it off 5 years. Looking at 15 years of service, over age 45, there's only one more that falls into that category. So in total, about 7 people could retire in the next 5 years. About 23% of the population. That's relatively typical. I'd say maybe it's around the low end. I've seen some funds where it's 50%, and that's a much bigger problem to have. Okay. And then the last thing I want to point out is on page 31. We do have a summary of the plan here. This doesn't replace Article 3, but it is only 3 pages and a little bit easier to read and reference. If you did have a question about tier 1 versus tier 2 benefits for any given disability, termination, those kind of benefits here. So that's a place to reference. I do have GASB numbers. I don't know that you're interested in those. I did focus on the funding here. Those GASB numbers do appear in your audit. The big difference between what I just presented in GASB is that there will be no smoothing. Accountants don't like smoothing. So market value of assets is utilized. So you will see more volatility in the funded status over there. Right now, market value as of valuation date is higher than actual value, so that you'll look a little bit rosier on the accounting side. The methodology for calculating liability is basically the same, uses the same cost method, all the same assumptions. There's a slight difference in how accounting versus funding has to look at something. So the numbers won't match exactly, but they're pretty darn close. So really, it really comes down to the way assets are treated on the GASB side of things. And then ultimately, GASB is going to determine that GASB 68 expense that gets booked. It's relatively close to your contribution, actually. So it's not too dissimilar in your case. Sometimes there's some more volatility in that number, though, depending on what assets do, because the other thing that happens there is where they do have some amortization of gains and losses on items, they amortize them very quickly. It's usually over a 4 to 7 year period versus you can see we're smoothing all of the gains and losses over 19 years right now. Eventually 15 years, still much longer than anything you'll ever see on the side. So there will be more volatility in all of the accounting numbers. With that, is there any other questions for me? It's a lot that we went through 5 numbers.
I guess the only would just be the difference between the two. Do we need to pay attention to the Gatsby stuff? I mean, is that,
It's just a more real-time snapshot, effective, you're probably, if the market continues down the path it's on, you'll see much more volatility likely next year. As she said, the GASB numbers look kind of better than what the actuarial numbers are because of the market having positive returns. Accountants basically say it's market value as of this day, and we recognize it. So,
Look at page 34 here quickly. I'll show you what that.
I mean, I guess it's more of just, a,
34.
do we need to, not that we should.
I don't know if there's much you can do.
Okay, so then-
Yes, it sort of says this is what's here. Here's a summary of the GASB results. So it's the same population that we're valuing. You do use the current valuation method. So same population that we just walked through for the funding side of things. In the middle of the page there, you can see the net pension liability. This is effectively your unfunded liability. So it's different terminology, different nomenclature, same concept though. And you can see that it's a little bit better here. So your funded status here is 65%. I showed you a funded status of 62.6% on the funded side.
So why do we have two different versions?
GASB did not accept the smoothing methodology that most of the actuaries use to help keep your contribution less volatile. GASB said we have a balance sheet date as of December 31st. We know what assets are valued at as of that date. So they basically go through and calculate a very similar liability, but the asset side is different based on that smoothing methodology.
So I could tell you, and this is public accounting, so GASB is the public sector accounting. I worked on the private sector side too. Theirs is even more volatile because they take market rates on liabilities, and we have to value liabilities on a market basis, and then assets are market value. So you could imagine volatility year over
And don't
year.
you be fully funded with that?
Well, that's the thing. It's not a funding basis. So it's just accounting. It's just for the perspective of putting things on the books, and having an expense on the books has nothing to do with having a funding. Which is why we spend most of our time walking through that. 'Cause that is what you guys do have control over, is how you funding plan, how to assess that. But
Now, if you didn't fund, it would impact how your percent funded looks even from a GASB perspective.
Yeah.
So there's still the impact of those municipalities that aren't funding what they should. Their GASB numbers don't look good either. If that makes sense.
I guess I'm just asking why do we have,
well, and so one
it
more,
doesn't matter. I just sort of,
it's accounting versus funding, and the same thing happens in the corporate sector too. So if you look at the very bottom of the page, you can see some other interest rates, right? So we did use the higher discount rate here for you, 6.5%. However, you can see that there's this high quality municipal bond rate of 2.25%. If you were too underfunded, we would be forced to use a blend of the 6.5 and 2.25% rate, and the liability could increase significantly if we had to do that. So some of these funds that are very low funded, we're using rates much closer to 2.25%. You can imagine what that does to liabilities. It's insane.
Yeah.
And so there's incentive to not be in that position.
so what, how do you end up, what's the threshold?
You know, it's going to vary because there's a test, a crossover test that we have to perform. And basically, we look at your funding policy, how you've been performing relative to your funding policy, and then we project that into the future to see at what point you run out of money. Because that will happen in these funds that aren't funding or funding 80% consistently. And once
So it's just another way to make it look like they're liable so much higher.
Yeah. And so that's disincentive, because obviously, you know, bond agencies, especially with this stuff.
Yeah,
it's
but there's no
disincentive.
hard and fast, if you're at 45%
No.
funded, then.
Yeah, no. And the idea there is if you ran out of money, you'd have to go to the bond market to issue that to pay those pension benefits. So that's why they revert to that high quality.
So that's
Which most of those probably wouldn't even qualify under the high quality municipal bond.
They're not
market.
getting
They're
those.
probably in junk bond status, we'll be honest, but, yeah, so that's why it
This is
reverts.
how we have to, and this is sort of their way to get to that and have that disincentive. Your fund's nowhere near this. Just letting you know that these things are out there, and those would be some differences that could appear here. I don't anticipate those ever.
You wouldn't have to drive too far to find one, though, I can tell you that.
That is
So-
true.
I think this is a tricky question. From a 10-year perspective, the unfunded has decreased. Is that right?
So I'd have to look back. So what happened was we have used for that. when we became the actuary, we did implement another assumption. I don't recall what the funding status was at that point in time, but I can tell you the prior actuary was more aggressive than ours, so we tried to make our assumptions as reality as possible because that predicts
That's right.
actual
Yeah.
numbers for you as best as possible. Whether you like them or not is another thing, but you know, our goal isn't to, we're trying to tell you the best picture of reality as possible. And so when we implemented those, your funding status likely went down from where that started.
So there is a history of the GASB calculated numbers for that, on audit pages 107 and 108 for the police pension fund, just FYI. Which will take you back to 2015. That was the first year implementation, if you recall, for the newspaper.
Well, we've been the actuary for largely most of this time frame, so you might not be able to see that perspective over 10 years here yet. Now, eventually, this will show up for 10 years. But in the end, you're doing all the right things. You're funding on, to the dollars that we're saying. So since we've taken over, we've seen a reduction because you're doing things to reduce that unfunded. Assumption changes can be quite volatile.
Right, it's gone up and down.
And that's also the goal, to keep assumptions as close to reality as possible. You don't see huge swings when we change things with assumptions, we're just sort of adjusting them and staying in line with reality. The big one will be if we ever make a change to the
And then once we get to the rolling 15, we'll have more.
right, because every year, whatever happens, we're re-amortizing it over. Basically, we have the mortgage.
Yeah. All right, anything else? Thank you.
Sure.
Okay, Carl.
And if you have any questions that come up later, feel free to shoot me a note or
Yeah,
give me a
thanks.
call. Happy to talk through anything.
Thank you both.
Thank you.
Yeah, we're at class and comp.
Help this class. I'm sorry. Okay. The last item on the agenda tonight is a relatively straightforward conversation as it relates to something we had mentioned to the Finance Committee a couple of times in the last few months, which is that we were initiating a review of the village's comp and class schedule. And I'm going to have Sharon kind of walk you through what is a fairly complex process, but it really relates at this point in time to only one classification. What I had mentioned last month was that we were going to perhaps take a look at several of the other classifications within it. And as we looked at it, we made the determination that those could wait until we got into the budget process. So, which is going to be here before we know it, because either we're in audit or we're in budget. That's really the only two seasons in finance. So what we are focusing on is that grade 9, and it's the last 2 pages of the packet, pages 167 and 168. Really, 165 shows you some of the differences between those recommendations, but it focuses on a specific position that we have a vacancy in, and actually we'll soon have 2 vacancies in, which are the deputy chief positions in the public safety department. And so I'm going to get out of Sharon's way so I don't steal any of her thunder, because I know you're prepped, but that is what we want to focus on really is that classification for this point in time, and then we will take a deeper dive on the remainder of the class and comp schedule along with the budget. So we'll talk through that in September. So I'll kick it to you, Sharon.
Thank you. That's a good introduction. So really what we're attempting to address is some compression that's occurring between salary grades 8 and 9, specifically the public safety lieutenants and the public safety deputy chief positions. As Bill mentioned, there's currently one, soon to be two vacancies in the public safety deputy chief. So this is why this is a very timely conversation as we're looking at the process to backfill that position. I'll give you two historical data points as context to this conversation and then share a bit about the recommendation. The first is that currently the village's municipal code requires that the deputy chief position is filled internally within the public safety department. And so that means we need to look at either our lieutenants or theoretically our officers that have at least 5 years of experience in the Glencoe Public Safety Department. So the issue of compression is a very real factor that we felt needed to be addressed mid-year, given the work that we have to do in order to fill the deputy chief positions. The second historical point that I want to share is a bit of background about how we arrived at this compensation and classification schedule. Jonathan, I think you had just come onto the board perhaps at the time, so it might be a trip down memory lane for you.
Vividly.
Vividly, right? It's the thing that you think about every day. I know, I do too.
Yep.
And so in 2016, we worked through a process with a consultant to create a uniform and standardized compensation and classification schedule that incorporated best practices in compensation. Where we were at the time was that our salary grades were not uniform. There wasn't a lot of methodology. They had probably been morphed over time, and so it was a bit disjointed. So we created this uniform schedule of classifications where each position in the village that's not in a bargaining unit was put into a salary grade with positions of like responsibilities grouped together in the same grade. So like pay for like positions. When that schedule was developed, there were a couple of components that were standardized. One is called spread, which is basically the percentage increase from minimum of the grade into maximum. So starting pay and ending pay of the grade. And the other is called gradation, which refers to the distance between one grade and the grade immediately above or beneath it. So our salary grades 1 through 8 were constructed so that there was 10% gradation between each of those grades. So that means that salary grade 2 started 10% higher than salary grade 1, and so on and so forth up to grade 8. Grades 9 and 10, which is where our senior management positions are slotted, have a 20% gradation, recognizing that those positions, if a position were to move from 9 to 10, you typically have an incumbent who's at a higher wage in their grade, and so that range is intended to start a bit higher. When we started to notice the compression that was occurring between the lieutenants and the deputy chief, we started to mine through our data to understand why this is happening. Salary compression generally occurs when incumbents in a salary grade or in a position are very close to the earnings of a position in a grade that's more senior or in a position that's more senior. So the lieutenant's salary grade, as we've had a class of lieutenants travel through their salary range over the last several years, when we first created the salary schedule, many of them were quite junior or not yet in that range. And then since that time, they've progressed through their range. We had deputy chief incumbents who are different at the time the salary range was created in 2016 compared to today. And so the compression wasn't as acute based on the salaries of the incumbents at the time. So today we are seeing that compression in that the lieutenants who are approaching the higher end of their wage scale are bumping up against the pay of the deputy chief positions. And as we're looking at filling the position of deputy chief with now 2, we feel that we need to address that compression that's occurring because there's not financial incentive otherwise for an individual to perhaps consider taking that career step. The compression is unfortunately exacerbated by the fact that the lieutenants are eligible to earn overtime and the deputy chief position does not. That's not formally taken into consideration in the salary schedule, but it is a real life factor that we need to be mindful of. And so what we did in the recommendation is we essentially increased let me back up one moment, I'm sorry. When we created the salary schedule, I've mentioned the gradations between grades 1 through 8 and 9 and 10. But as we tried to peel back the onion and understand why the compression was happening, What we learned is that grades 8 and 9 were not constructed in relationship to one another. So grades 1 through 8 had 10% gradation between them, 9 and 10 had 20% gradation to them. But what we found when we calculated that out is that 8 and 9 only had about 4.4 gradation, 4.4% gradation, meaning grade 9 started about 4.5% above grade 8. So that's why we're seeing this compression. Again, it wasn't as apparent when we created the salary schedule in 2016 because of the incumbent salaries. But we noticed it in today's environment, and as we peeled that back, we found that to be the primary source of why the compression is occurring.
And so to follow on that, when the schedule was created and they said, oh, what's going on up, and here we are at 8, and now we're looking at who's in 9,
Right.
seeing where they're at, building our schedule almost around that, as opposed to saying just follow the pattern, et cetera, because it would have put them in off position. So now that those people are now coming off the system, we're bumping it. We're finding the compression that wasn't obvious before.
Yes.
Okay.
Yes. And so our recommendation is to increase the gradation between grades 8 and 9, not changing the salary range for grade 8, not changing the salary range for grade 10, which is the grade above 9, because we're not trying to boost the entire salary schedule. We're trying to address that compression that's occurring. So what made the most sense from a recommendation standpoint was to move the minimum and maximum for salary grade 9 such that the gradation between 9 and 10 is pretty close to the gradation between 8 and 9. It's about 11 and 12% respectively. Or I may have that reversed, but it is quite close. It's about as close as we could get it without getting to some pretty funky decimal points. And so our recommendation, sorry.
And I was just going to say, in real numbers, that equates out to approximately additional $11,000, almost $12,000 increase in maximum salary in grade 9 from where it exists today.
And the increase in the minimum is fraction of that.
The increase in the minimum is about 8,000.
Yeah.
Mhm.
And there is some overlap between grade 8 and grade 9, so they almost kind of stack on top of each other, kind of like that. So that somebody who is already at the top of grade 8 is going to be more than midway through grade 9. So it is important to have that headroom, particularly as we're looking at promotional opportunities in the public safety department. Again, that position is where it's the most, the compression is pronounced. That's where we would generally see movement from grade 8 to grade 9 is in the public safety department.
My other question would be, so why do you have the minimum well below the maximum between the grades? If you're kind of, if the normal process is getting promoted out of one into another.
Because not all positions are created equal. So in that particular grade, grade 9, we have 2 classifications. We have deputy chief, but we also have assistant village manager. And so it provides flexibility from the standpoint.
So
Yeah. Not every position has to be hired in exactly the same way. But yet we try to cluster them because they have similar responsibilities within the organization.
There's market forces.
Right.
And what sort of created this originally? Why do we have grades that fall? There's not that many people in the organization. Why do we not just have jobs?
It is good practice and compensation to have salary grades so that you're paying positions with like responsibilities, a like salary, or they have like earning potential. That said, there are some organizations that adopt different compensation philosophies where they do exactly what you just said, which is, okay, this is the salary for this position, and this is what it is.
I think what we saw before this was put in place was relative inequity across the organization in terms of like positions for like compensation. There were certain positions that were compensated significantly less than others, even though they have very similar responsibility sets across departments. And so the intention behind it was to equalize that out across the organization. It is not a perfect plan from the standpoint of functioning, especially as the recruitment environment changes. I think one of the things that we will look at in this more comprehensive review is when positions change. And you'll note, we don't have anybody in grade 6 right now because positions have graded out of 6, either up or down, and because of responsibilities that have shifted. That may mean we need to look at it kind of holistically again. And another aspect is we have talked and not implemented different compensation structures related to merit-based pay. If we were to implement something like that, that may alter the classifications as they exist today too. But I would say that this was a significant improvement over where we were at the time, but it is not necessarily etched in stone that we would utilize this plan forever.
Can I illustrate what Phil mentioned about the compensation ranges that were in place before we created this structure? I remember this because the numbers stick out in my mind. One position had a 6% spread from top to bottom, range minimum to range maximum. One position had a 60% spread from top to bottom. So it was, there were some positions that were pretty disjointed in that regard. And so we wanted to standardize them and get them into ranges that were more uniform.
I mean, I'm not, but there could be jobs where that should be the case, where you stay
There could
in a
be.
job for a very long time, versus one where you're expected to get promoted out of that job. And so a wide range is legal.
That may be true. I think it depends. There are, I would say that in an organization like this, because of its size, we don't have a lot of promotional opportunities within the organization. So often people leave if they move up, unless something opens up. So the concept of a lifelong career progression in the organization is a little bit less likely here than perhaps in a larger municipality where you have multiple people doing multiple of the same job. And so different opportunities exist.
I mean, ultimately, the whole reason for it is to make sure you can hire people who you want to hire. And
Correct.
keep those who you want to keep.
Right. I would say that I think these ranges remain competitive in most cases. I think there are, as we said, that's why we want to take another deeper dive look at this before the budget process. The environment is shifting a bit. We want to be mindful of that. We're not talking about going crazy, but there are certainly changes that have that we're starting to see in the way we recruit. I will also say what we continue to work toward internally is looking at non-compensation related benefit programs. We are seeing for sure significant interest in 2 programs that the village has put in place in the last year, which is family leave policy and flexible scheduling. And those, I think, Sharon, you've said to me, the first questions we're getting from many candidates for almost every administrative position is, tell me about your flex scheduling policy. So having those in place is actually providing us a benefit that does not require a associated dollar figure. And other communities are not able to share a similar benefit package. So it isn't all about money. It's about experience. It's about the opportunities within an organization. But at the end of the day, money is pretty important too. So that's where we'll want to make sure we're focusing in the right places.
To get back to the money, do the changes you're recommending address the overtime?
They don't fully address the overtime thing because overtime is a unusual animal. It can come in fits and spurts. And so there are going to be circumstances where we have lieutenants who make as much or more than the chief because of a given year and a set of realities. As we were talking through in the actuarial reports, our head count is down significantly. When that happens, that triggers overtime. And so that compression will always exist in an overtime environment in an exempt versus non-exempt position. In a deputy chief versus a lieutenant, the likelihood is that you gain other things by losing the overtime. You gain a more standardized schedule. Those kinds of things come into play differently. But you never fully eliminate the potential for a subordinate employee to out-earn their supervisor. It happens on a fairly regular basis.
So what do you need from us?
We wanted to talk through it tonight. It's on the agenda Thursday night to approve this classification change. Again, as I said, it's a modest one. This time around, we wanted to address this because Sharon just sent me the position announcement for the deputy chief. We had intended to begin recruitment for the one vacant position. We now have a second one that'll become vacant within the next couple of weeks. So we want to have this new structure in place as we begin those recruitments. Okay, thank you.
Thank you.
Thanks. Any other comments?
Thank you, everybody.